Hello financial fans, welcome back to another stock analysis. Today we'll be covering Alphabet Incorporated, stock ticker GOOG. Alphabet is a multinational conglomerate holding company that was created as the parent company of Google. The company was formed in 2015 and is headquartered in Mountain View, California. Alphabet holds several subsidiaries that operate in a range of industries including technology, life sciences, investment, and more. The company's most well-known subsidiary is Google, which operates the world's largest search engine and provides a wide range of other products and services including email, cloud storage, mapping, and more. In addition to Google, Alphabet holds several other subsidiaries including Waymo, which is self-driving cars, Verily, which is life sciences, and Capital G for venture capital. The company's goal is to provide a wide range of innovative products and services that improve people's lives and help solve some of the world's biggest challenges. They're currently sitting at a $1.2 trillion market cap, and in 2021 they generated a revenue of $280.9 billion. And they're the fourth biggest company on Earth right now. 58% of their revenue is generated through Google Search, 12% through Google Network, 11% through YouTube, 11% from apps, hardware, and content, and the remaining 8% from Google Cloud. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors on a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from our margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from our margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up, going from $15.4 billion in 2013 to almost $75 billion in 2022. The average EBIT growth was 21.4%, meaning a 10% deduction from a margin of safety. The margin has stayed somewhat flat, going from 27.7% to 26.5% in 2022, making a big dump into 2019, but managing to regain itself in 2021. Therefore, the margin growth is still positive at 0.3%, but it's not enough to get a deduction in our margin of safety, so no change in our margin of safety. According to ratios are the debt to EBITDA and return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this we get the amount of years of EBITDA it takes for the company to pay off all of their debts. As you can see in the graph, the debt is very small compared to the cash and the EBITDA. In this case, all of their cash can easily cover all of the debt that Alphabet is bearing. So that means a 0% debt to EBITDA ratio because Alphabet Inc. has no net debt, meaning a 5% deduction from a margin of safety. The return on invested capital is also looking very solid at 29.6%, meaning another 5% deduction from a margin of safety. Looking very good so far for Alphabet. So let's go look at the valuation models next to determine the intrinsic value of Alphabet. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Google going from 2012 to 2021. The average growth in free cash flow annually during this period was 23.16%, and I'm projecting an expected growth rate of 10% over the next 10 years annually in their free cash flow. With this percentage, we can determine the future free cash flow for Alphabet and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 9%. This leaves us with a sum of free cash flow of almost $1.6 trillion. And to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $1.67 trillion. All we have to do to get our discounted cash flow price per share is to divide it by the amount of shares outstanding, leaving us with a price per share of $280.68, which is almost a 200% upside from this point out of this model. The second valuation model that we'll be using is the Graham's revised valuation formula. In this model, we'll be looking at the earnings per share that Google is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds. And we go by the theory that a PE of a company with no growth is 7. Looking at all of these metrics, we get a fair value of $110.99, which is a 17% upside out of this model. The third valuation model that we'll use is the multiple valuation. In this model, we will be looking at similar companies to Google or companies that are somewhat similar to Alphabet, and we'll be looking at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is 25.29. To get our fair value, we just have to multiply it by the earnings per share that Alphabet is generating, which is $4.53 a share. This gives us a fair value of $114.55, which is almost a 21% upside out of this model. The final model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metric that we use to determine this is the PE ratio. I've imported the PE ratio of the past 5 years, and the average PE ratio during this period was 22.54. The current PE is sitting at 20.94, meaning that it's currently undervalued, leaving us with a fair value of $102.13, which is a 7.66% upside out of this model. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, Graham's valuation, the multiple valuation, and the mean reversion theory prices per share, leaving us with an average of $152.09. We've determined our margin of safety earlier using a standard margin of safety of 25%, deducting it by 5% for the debt to EBITDA, 10% for the EBIT growth, and 5% for the return on invested capital, leaving us with a margin of safety of 5%. Applying this margin of safety, we get a fair value of $144.48, which is a 52.31% upside from the current price. So in this case, it indicates a buy. If there's any other companies that you would like to see me cover in this channel, please let me know, and thanks for watching.